All right, Dan. So we thought we'd just do a quick short about current questions we're getting. And one of the current and hot questions we're getting right now is all this market volatility. What's going to happen? How do you respond?
I don't know.
Good question. Yeah, good answer.
If I knew the future, I probably wouldn't be sitting here.
No, he'd be on a boat somewhere.
Yeah. I think it reiterates to us and should for investors of being diversified.
Yep.
Because certain investments are actually
up this year.
They're very positive this year.
Yeah.
And people are like, I didn't know that. You go, yeah, well, that's why you need to spread the wealth around, because you just don't know what particular investment is going to do very well one year and not so well the next year. Nobody knows that. They might make you think they know on MSNBC and in some of these Bloomberg and all these TV shows, but they really don't know.
Yeah.
I mean, that's why Money Magazine, every other month comes out. These are the 5 stocks to own today. You're like, what happened to the 5 stocks from like 2 months ago?
Right.
They're not telling you to buy the same ones or different ones. You're like, this is weird. So, stay diversified. It tends to limit the volatility. It won't eliminate it.
Yep.
And focus on what you can control.
Yeah. And so that's a great point. So, for example, if you're taking income, having that safety net built in when the volatility kicks up. One of the things we've done is we had 6 months to a year of income distributions in a money market, right? We can earn some interest along the way, but we're not taking this risk with the volatility in the market.
Yep.
And so that's been great. And so you can control that. You can control, hey, if I'm going to take out $50,000 or $100,000 a year, where should I have that? What will dividends and interest replace? I should have that the rest of 5 to 7 years. We like 5 to 7 years because from our perspective, that's one of the longest times it took for the market to recover.
Yep.
So we don't have to sell equities when they're down. And it also does another thing. When equities do, if they hit down 20%, 30%, we could sell, those safety positions and we can buy stocks lower. We could sell high and buy low. So it's all about the rebalancing, and if things have done extremely well, like last year, we had certain parts of the market that were up 30, 40%. You probably should sell a little bit of those, take some gains.
And when I say you focus on the things you can control, somebody might be listening and go, well, I can control whether I'm invested or not.
That's true.
Right? And so I look at how successful you're going to be in your financials as based on what you spend, what you save, and what the market's going to do. Well, the two things, what you spend and what you save, you can somewhat control that.
Yep.
All of it. You can't control the market, but somebody watching might go, but I can control when I'm in and when I'm not in the market. And you go, you're going to get it wrong.
Yes.
Because if anybody could do it on a regular basis, they would be. And nobody can.
Right.
All the data shows that's not really control. You feel like you have control because you're taking action to get out of the market. But you got to get back in at the right time.
Yeah.
And then you got to be able to do that regularly moving forward, because the market does this over time, right?
And we tend to see
chart here somewhere that shows us that. There it is.
And we tend to see when the market turns, it turns quickly.
Yeah.
So, you may time close to the top or get it right, but getting the bottom right, usually the comment we hear is, I'll get back in when things get better. I'm like, well, define when things get better.
Actually, you should be getting back in
when things look awful.
The worst.
Yeah.
The worst. That's usually when we're at the bottom.
Right.
And if they're waiting for things to get better, that means they've waited for it to go back up, and now they've missed out on some relative rate of return. So focus on what you can control and stay diversified.
Great answer. Well, thank you. And if you have any questions or are interested in seeing how your portfolio lines up, feel free to reach out, and we'll be happy to talk to you.